Hi, I'm Rich Rudolph. I'm an independent risk management consultant and also a faculty member and ed consultant for the National Alliance. And I'd like to share some thoughts with you today on enterprise risk management. I first heard this term in the early 1980s. I was working for one of the large insurance brokers in the Chicago office. No one knew what it meant then, but when we heard about it, it was exciting. And then a few years later, when I became an independent risk management consultant, we never used the term enterprise risk management, but the way we advised our clients, it was clear we were practicing it. We just didn't call it anything. One of the interesting things about enterprise risk management is if you put 12 risk managers in a room and say, okay, define it, and then you can come out. When they come out, you'll get at least 13 definitions, which is really pretty cool because enterprise risk management is so individual to the organization, and organizations are so unique, no one will ever have the exact same definition. So however you define it, there's two important characteristics that are common. First, it's a coordinated, collaborative, cross-functional effort for treatment of risk that goes across the organization. Everyone is responsible for managing risks, not just a risk manager who focuses only on the bad things that happen, perils and losses and hazards. Second, enterprise risk management is proactive. We look for opportunities, potential upside opportunities. Well, traditional risk management just focuses in on the negative, the downside, perils and hazards and bad things that happen. But here's a key point to remember. When we insure something, we're concerned about that downside, but we insure it through an insurance company who's looking to make a profit, the upside risk. Yeah, they have to make a profit of some amount, otherwise they're not in business. Well, that's upside of risk. It's been around for hundreds of years, but we just didn't call it enterprise risk management. And here's one way that we used enterprise risk management to help one of our clients. I'll call them Ajax Properties for convenience. Ajax owned a lot of shopping centers. They had about $3 billion in property exposures spread over 50 locations in 20-some states. And about 40% of those values were in windstorm areas. The property exposure was insured in the traditional market, and we used a $200 million blanket policy, which was enough to cover the total loss of its two largest shopping centers. And it had, for an account that size, an astonishingly low deductible of only $5,000 for most perils and $50,000 for wind. And Ajax even wanted lower deductibles, which sounds crazy, but they could pass 100% of insurance premiums on to their tenants through the common area maintenance charge, but no part of any deductible or retention. And then came Hurricane Katrina in 2005, and the insurance market, of course, raised deductibles from those modest amounts of $50,000 or so for wind to 10 or even 15% of total insured values, subject to minimums of $5 million per Ajax location. That was simply unacceptable. Too much risk for Ajax. Our ERM solution was to form a captive insurance company whose sole function was to insure only the deductibles, thus limiting the exposure of the captive to $5 million per location. And even at that time, reinsurance on that small exposure was still readily available and affordable. And because the captive charged a premium, that premium could be passed on to the tenants. And then we said, well, if the captive can do that, let's put the $5,000 deductible in the program also. And that, in effect, created a zero deductible property insurance program. Then we decided that we could add sublimited property or excluded property, like trees and shrubs and losses from windstorm on trees and shrubs. And then we said, well, if we can do that, let's add the deductible for flood and for earthquake. And then after a few good years, fair insurance pricing, no losses, the captive became a profit center for Ajax. Ajax got to take advantage of the upside of risk while still addressing the traditional downside. So you can call it whatever you want, enterprise risk management or enterprise-wide risk management, holistic risk management, integrated risk management, strategic risk management, or whatever other fancy name you want to come up with. But what it always involves is thinking about risk in a different manner and looking for the upside opportunities, not just focusing on the downside. So, take some risks, have some fun, but please be safe.